Our next guest says that if we get a correction in the next few weeks, it will likely be led by the year-to-date winners. Joining us right now to talk markets is Zachary Hill. He's the head of portfolio management at Horizon Investments. And Zachary, what are you talking about here? You just think some of these stocks that have been high flyers are due for a pullback?
Yeah, that's exactly right, Becky, and great to be with you this morning. We just seen, as we look at price action, just really extended behavior from a lot of different parts of the market, from retails and professionals. And a big part of the market climbing the wall of worry this year has been the fact that we've been underpositioned as a whole, as an investment community. And, as we look at it across the board right here today, we don't think that's the case anymore. And so we wouldn't be surprised if the next 5% in markets is a down tape, see some rebalancing from stocks into bonds, and some buying of those, things that have gotten really lagged this year, and selling of some of those AI related names that have led the market.
You all have about $8 billion in assets under management. Have you changed your investments as a result of that thought? Have you changed what you're allocating to technology?
Yeah, so we run, obviously numerous strategies, and so it's going to depend a little bit. But in our more tactical strategies, we have gone from, overweight that mega cap technology, that top of the market that's really been leading, into a slight underweight and looking for that rebalance, price action over the next few weeks. More strategically, as we look across portfolios, this year has been about, decreasing our overall U.S. overweights in favor of international markets. A lot of that has to do with just, cheaper opportunities in the dollar, which, while it has kind of confounded analysts over the last couple of weeks, we think it's, kind of best days are behind it. We're going to see, fewer headwinds from the dollar. And so those kind of things have had us moving in that direction across portfolios really over the last couple of months.
We have seen such a huge run in the first half of the year. What do you think the second half of the year is going to bring?
Yeah, so, more medium term, I still do think, the path of least resistance for markets is higher. That has to do, the primary, kind of reason for that is just the underlying strength of the U.S. consumer. I mean, it's completely underappreciated, but, balance sheets, but in the private sector, in personal balance sheets and corporate balance sheets are just in a really strong and healthy position. And so we can handle higher rates. It's no surprise that the market doesn't believe that. The 2010s period has been all about the exact opposite. And so we think this is just a different cycle and one that has further room to run. And, over the medium term, despite that, near term bearish outlook that I just articulated, we think that matters, and will translate to higher asset prices.
The whole thing that we've been watching with the Fed, you're not concerned about that? You don't think it's going to catch us up in the second half with any sort of consumer pullback, with any sort of recession, or has that already been baked in?
I think a lot of that's been baked in. I mean, I don't know how many Fed speakers were on the calendar this week, but I probably can't count it on both of my hands. And so, we get a lot of information from the Fed. And so it's really well known what's going on with policy. And so, I think this, at least for this year, likelihood they're gonna hike 25 basis points in July. I think that's basically a done deal. That was decided at last week's meeting. Beyond that, it's going to be a little bit of how the economy, how the economy evolves, and that's obviously uncertain. But really, in the grand scheme of things, another 25, 50 basis points when you've already hiked by 500 basis points, we really just don't think that's that relevant anymore. And you can see it translating into lower bond volatility, which overall is just a really positive thing, for market pricing environment. And so, we're not spending as much time as we were over the last, year, 18 months parsing Fed statements, because we just think it matters a lot less, for the 2023 trade. Now, what
about earnings season coming up? I mean, that's believe it or not, right on the horizon again. That matters more than the Fed at this point, you think?
Yeah, I think so. I mean, there's been, a lot of uncertainty around, guidance for the rest of the year, and some optimism, quite frankly, that things are going to, pick up in the back half of the year. And so that's something, that always worries me a little bit, and say, okay, are you, yes, it's not great right now, but it's going to get better. And so, how do we see, company CEOs guiding for the remainder of the year? They're going to have more clarity, and the market's going to want to hear it. And so that's something that we're going to be watching. Obviously, also watching the financials. They report first, and to the extent that a couple months ago we certainly cared a lot about credit transmission to the economy. That's died down, but would love to get a better look at that. And then lastly, on the AI side of things and technology side of things, I think last earnings quarter was really about just kind of promising that you're in this space and that you're doing something related to AI. And I think now, as we've seen performance across the sector, has really caught up with that narrative. And so we're going to need to see some more tangible numbers. And so that's another part of the reason why we think we could get a little bit of a correction and what we do think is a really long-term bullish dynamic.